Welcome to Straight Talk and Retirement. Your no-hype source for financial advice in making informed choices about your retirement planning. Get on the phone to talk today at 314-931-5877 or text your question to 84126.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Now, here are your retirement coaches, Jeff and Aaron Lapidus.
Well, hello, St. Louis, and welcome to Straight Talk on Retirement, your live and local St. Louis's favorite financial call-in show. I'm Aaron Lapidus, president of JBL Financial Services, financial planner and wealth manager, and we are all back in the studio together. Dad.
Babe.
Rob.
Honey.
Oh, that's cute. I love that. All right, well, we help our clients make smart choices about their money. The way we do that is by designing a game plan, a written step-by-step strategy, a real game plan with several goals in mind.
First is to preserve, protect, and prudently grow the assets our clients have taken their entire lifetimes to accumulate.
Second is to provide an income stream they can rely on so they can do all the things they want in retirement.
And third is cost-effectively addressing their health care needs, like helping individuals enroll in Medicare and choosing the right plan to couple with their Medicare coverage.
And then when they're done enjoying their assets during their lifetime, we show them how to pass them on to the people they love, whether it's their spouses or children, grandchildren, churches, or charities, whoever it might be, without Uncle Sam or the tax courts taking a big bite out of their money. And as their wealth managers, Aaron, Rob, and I watch their money every single day to make sure they're staying on track. And that's why they call us the retirement coaches. Good morning, kiddies.
Good morn.
You know, it is a good morning, and honestly, I'm not missing being in the big chair today.
You're not missing it? We can open with honesty. I'm just glad the market's not open today. Everybody needs a breather.
It's curious that you might say that, honey, because we know that year to date, the S&P 500 is down 13.73%.
So everyone who felt like yesterday and the previous day lasted a year.
It did.
It did.
The Dow's down approximately 10%, and the NASDAQ is down 19.28%. Not 30%, not 50%. But 2 days of volatility in a row that we had certainly can be unsettling for investors. But frankly, fun for advisors.
It is an opportunity.
Well, there are two sides of the coin here, right? The one side is prudently grow. The other side is protect what we have.
Right.
So that's our job. Grow it prudently and protect it so they can have an income that they want, so they can do all the things they want to do, and eventually pass it on to the people that they love.
Certainly.
So this is a time that tests the mettle of your advisor, which is great. And we know that all of our clients are folks like you. They're our listeners. They're 55 and older. They'd like to retire. They're already retired. And we sent out a very nice email yesterday.
Yes, we did.
One that you created solely by yourself, which I was very proud of.
Well, thank you.
I thought it was great. I enjoyed it, and I know we're going to refer to it during our show today.
We will. We also took some time several weeks ago when the volatility picked up, not nearly to the extent that it has today, or over the last couple of days, basically reiterating many of the things that I said in our first email. But what I think we should do first is talk a little bit about the ways that you can stay in contact with us throughout the week, especially when times get more volatile. So if you'd like, you can log on to our website, jblfinancial.com. In the upper right-hand corner, there's a Contact Us button where you can request a coaching session, financial, Medicare, or both. You can ask a question. If you'd like, we'll get back to you as quickly as possible. On the lower left-hand side of the screen, there's a pop-up box that appears that says sign up for our monthly newsletter. We call it the Coach's Corner, and we were not in studio for the first day of April, so Rob, tell us a little bit about what is in our April 2025 newsletter.
As we speed run these months in 2025, our April 25 newsletter has some great stories you're certainly going to want to peruse. The first one being tax time procrastination can be common and costly. And, 3 out of 10 Americans say they wait till the last minute to file. 50% rush to complete their tax returns as quickly as possible. And there's a great little infographic that's associated with the article that really lays out some of the top reasons why people procrastinate. And 51% said filing is too complicated and stressful. And my only thought on that would be probably true, but if you wait till the last minute, doesn't it compound those issues? Probably, right?
Probably.
I mean, if it's something you didn't want to do because it was complicated and you wait till the last minute, I mean, you're more likely to make a mistake when you're under the gun, too. So, definitely.
Well, wasn't it Tony Robbins that says you don't act until the pain of inaction is worse than the action itself?
Yes.
So that might be some of the psychology behind it.
Not going to argue with Tony. Just not going to do it. Our next article, Debt After Death, How Are Debts Settled After Someone Dies? This is a great article. It can really fill in some knowledge gaps to the extent you might have them. And debts are paid in a specific order. Secured debts are first, mortgage, car loan, funeral, taxes, medical expenses, and then comes unsecured debts, credit cards, personal loans. If you are the cosigner of said personal loans, you could be responsible for satisfying those debts. But the real takeaway in this article is, because, we see so much of it, is how you can be contacted by debt collectors and, is there a limit to how much they can contact you? If you're the executor of an estate, you can be contacted by debt collectors. But if you are not legally responsible, please do not allow these people to bully you into getting personal information or other personal identifying information on a loved one, because we know that, unfortunately, death is not a vacation for the scammers, and that is exactly when they look to strike, and they have you at a very vulnerable point. So it's just something to keep in mind that if you're already going through a stressful time, you don't want to compound that by allowing the unscrupulous getting their foot in the door, so to speak. And our next article, Catch Up for a More Comfortable Retirement. Only a third of Americans over 50 felt like their retirement accounts were keeping pace with the cost of living. And there are some things... I
wonder what they feel today. Shouldn't take light in that. Go ahead.
But there are ways that you can supercharge your savings, and one of them is using the catch-up provisions. And if you participate in a 401k, 403b, 457 plan, you can sock away up to $23,500. And if you're over the age of 50, you can turbocharge that even further by $7,500. And they've just added another provision where if you're between 60 and 63, you can pile in $3,750 more. So that brings the grand total out to $34,750. So that's quite a savings. And the great thing I like about this article, it really shows how those catch-up provisions can help turbocharge your retirement savings, because they have the graphs here of those that take advantage and those that don't.
Sure.
Those that begin to draw on their retirement or take distributions from their accounts at 65, on average, had, I wrote it down here, $280,000 more than those who didn't. And for those that wait till 70, that number jumps up to almost $400,000. So not an insignificant amount by any means.
So not only adding to your savings, but potentially delaying taking some of it.
Absolutely.
So I think they call that the time value of money.
Yes.
So it's a great little graphic.
And our last article, have you checked your Social Security statement lately? It's very easy to do. Once you get over the age of 50, they automatically send you out a mailer showing you your benefits. And keeping you abreast of where you are vis-a-vis your Social Security. But it's very easy to do. If you log on to ssa.gov.my account, you can create an account, and you can log in at any time to see exactly where you're at. And I would definitely suggest peeking in periodically to see what that benefit is and what you can expect. That way there are no surprises, because one thing we don't want to be is surprised in retirement.
That's a great point.
And that is your April 2025 newsletter.
Awesome. There are a lot of great articles in there. So please log on to the website, jblfinancial.com. If you don't already receive it in your email the first of every month, hit sign up, and we will start sending it out to you.
Exactly, and our phone lines are open, so don't forget to give us a call or text us today, 314-931-5877 or 84126 from the KTRS text line.
So did we want to get into our first topic, or we have already received a text question?
Let's talk to the listeners.
Sure. So this is a great text. I think that we might want to turn the premise of this into an ongoing segment. So it starts out, finance or cash? It's a good one, right?
Sure.
We signed a contract for $1.5 million home. My question is, should I pay cash or finance? We currently have $6.3 million in retirement savings and are drawing 3.5% monthly. I am 63 and my wife is 59, and we do not plan on taking Social Security for a few years yet, and when we do, we will be receiving approximately $70,000 a year. We will have between $300,000 and $400,000 in equity when we sell our current home. I can pay cash, but that would require selling the selling of some stock. With what has happened this week in the market, I am hesitant to sell a lot right now. Rather, I think a mortgage of 6.9 with half or less down, the plan would be to pay it down as quickly as the market starts to rebound. What are your thoughts?
Well, honey, unfortunately, I don't have a mortgage calculator in front of me, so I'm not really sure what the monthly payment would be. But it sounds to me like our texter is thinking, and I'm just projecting this, is that their Social Security benefits are basically going to make their mortgage payments.
Sure. Or, well, I guess so let's just take the numbers.
Or maybe they weren't thinking of this, and I gave them a good idea, but
Right.
It sounded like their cash flow is sufficient to meet their income needs, so
Right.
Security would be on top of it. So, you got a two-sided decision here. Can I live with a debt payment? Some people are just like, I just can't do it, I don't want to, or I can, I just don't want to do it. Other people are like, I've had payments all my life. What do I care? If I have the cash flow to meet the payment, and in this case, it sounds like they probably also would be able to itemize their deductions. Woo-hoo! Not a bad deal.
Right.
Not a bad deal. And then if they get to a situation where it sounds like our texter is thinking, okay, when the market recovers, I'll still have sufficient capital. I can either pay it down, get my payment lower, or eliminate it. Not a bad deal.
I definitely agree with that. I think that I always think that financing gives you the most choices because, and we'll probably get into this a little bit, which is we don't know what's going to happen in the market on Monday. So taking the financing, saying either one, I want my assets to rehabilitate, or maybe I'll take the opportunity to do some tax harvesting if part of their $6.3 million is in after-tax accounts. This is one of those opportunities that you might have that didn't come around in the last 24 months to say, I'd like to do a little tax harvesting in the portfolio. Maybe you've generated a little extra cash that you can either use towards the house, or you keep that in cash to invest somewhere elsewhere, but the financing gives you the flexibility to say, okay, we know we've got the 6.9% interest, but one, that might not last for very long. You could see interest rate reductions that could allow you to refinance. Or secondly, you get to become, as you, Dad, like to say, your own banker, which is, you've got the monthly payment to meet, but you can accelerate that payment as much as you'd like over time. I think not doing anything knee-jerk, certainly not selling into a market that just lost 10% across 2 days, essentially, would be my last choice.
I agree with you. Again, I would tell you that from my personal experience, I have several residential properties. One is free of debt. One isn't. It's okay. If I feel compelled, I have a cash flow, so therefore I can make the payments. Not a big deal. I can't itemize. That's a big deal. But at the end of the day, it's just really a matter of, do I feel comfortable with the cash flow in terms of doing that? And the answer would be yes. And so I think, as you said, the real power is having the money and being able to satisfy the debt. Not having to do it, you're doing it on your own terms, being your own banker. So we do like that. And if nothing else, maybe our texter thinks of a compromise. You take out a 30-year mortgage, but you amortize it at a 15-year rate. So you're already paying down a little bit every single month. And if you decide you want to accelerate that into a 10-year 10-pay or a 5-pay, it's cool to have those options. But I do like the idea of saying, hey, let's wait for the markets to recover, which we hope, and history has told us eventually they will. You're not rushed. Don't rush it.
Yeah, the financing certainly gives you more options, and like everyone says, you don't have to. You see this with car loans. Well, if I take out the car loan, that doesn't mean that you have to
pay it back in the 5 years.
You can pay it back in 2 years. I mean, you can decide the terms by which you pay it back, and having that flexibility once you spend the cash, it's gone.
Also, we don't know what the new tax law is going to look like. We really only have tax guidance until the end of this year. So depending upon what happens, you might find that the laws are more favorable down the road to pull more from retirement accounts, or whatever the legislation creates will make things more favorable for you in the future. So in a lot of cases, especially when we're talking about paying down debts for clients or liquidating payments, I've suggested, why don't we just pause for a couple of months, make a couple more payments at the normal rate, and we'll see what the legislation looks like. That could give us guidance for the next several years as to what the best course moving forward is. We've got a lot of just unknowns out there at the moment, so making any long-term plans in terms of how we're going to liquidate debt probably could just hold off, hopefully just a few more months.
Yeah, you hate to make decisions when you don't have a complete picture of the battle space, so to speak. So sometimes taking the financing and waiting till you have a more complete picture, you can make a better decision. And who doesn't want to make a better decision?
Good text. Again, our phone lines are open. We'd love to hear from you. 314-931-5877 or 84126 from the KTRS text line.
I really like this idea, though. Finance or cash. It's like love it or list it.
Yeah. Why not?
Might have to bring that on as a regular topic.
How about both? No, I mean it's
right. It does. Nothing has to be all or nothing.
Exactly, and a lot of things are put to you as all or nothings, but very few things in life are all or nothing.
Okay.
So I think everybody's patiently waiting for us to delve a little bit deeper into the last 48 hours.
Yes, and certainly it's been. I thought that was a nice way to put it.
I feel like that's a sound that should go on one of those soundboards. You just press it.
Exactly. And again, as I just mentioned, we went down about 10% across the major indexes in the last 2 days. Mm-hmm. In total for the year, though, the S&P is only really down about 14%.
Right. But
I can say with a fair amount of certainty and not getting in trouble with compliance, maybe. I looked over all of my client review appointments for next week.
Sure.
And I can tell you that none of our clients, because they were diversified.
Sure.
We're down even half that.
So I
which
think,
is great.
Right. And so what I would say is, for all of you, if you are feeling anxious, don't look at your retirement account, especially if you are not currently retired, you're just accumulating. Don't necessarily give yourself the headache. But keep in mind that when you're watching the indexes go down, just as when you watch them go up, you don't get to participate fully unless you are fully invested in equities, meaning you have no fixed income in the portfolio. Also, our indexes don't take into account international investment. So if you have investment internationally with other countries using the CFA index, you're also participating differently. So if you have a diversified portfolio, you're not going to 100% track any of the indexes. So you should rest a little assured that you're not taking the full ride.
Well, and, also as a historical perspective, we were discussing this just a little while ago in the office. The last 2 years have seen tremendous gains in the markets. If you've been invested, you've participated. So we're really not giving back principal. We're just giving back some gains.
Really the gains that kicked the year off.
Yes, exactly. Pretty much. So not fun.
Certainly not.
Is the sky falling? The answer is, my opinion, no. Will this end? The answer is yes.
It always does.
It always does. And then we typically see a very good recovery. I thought what also leads me to that decision are two other things. The economic numbers that came by this week.
Yeah, that monster jobs number
right.
Friday morning was unfortunately completely buried by the market news that was
right.
unfolding throughout the day.
And we're talking about here is significant gains in non-government jobs, which is really what the economy is all about. So employers are hiring. We also know that there's still millions of unfilled jobs out there waiting to be filled. We also know that the participation rate ticked down, which is okay. So,
and also
my buddies. I will
buddies.
tell you, my own empirical studies that I typically do is with my golf buddies, as I like to say,
because they're in the construction business,
right? The sewer guy, the cement guy, and the asphalt guy. And I'm always asking them, tell me about your backlogs.
And do they still have backlogs?
They have backlogs. They're still very full. They still can't find enough people to work for them. But they're not slowing down. The minute they start slowing down, the minute I'll start getting nervous, because we know the construction industry is typically the first ones that lead us into, or the leading indicator in terms of going into recession. But that doesn't seem to be in sight. We also know the Fed is saying, hey, we're not going to lower interest rates at this moment. Why do they raise interest rates? To try to cool the economy. Why do they lower interest rates? To try to rev up the economy by making lending less expensive for businesses as well as for consumers. But they're not doing anything. And I would say it doesn't surprise me, because the economy is humming. The underlying economy is humming around. The goal of this round of tariffs, at least has been said to us, is that it should be leading to greater level of domestic manufacturing, which is good, by the way. More people here, more jobs, et cetera, et cetera. Not going to happen next week, but they're laying attempting to lay the foundation to do that. Whether they're able to do so or not, it remains to be seen.
And there are always unintended consequences to policy decisions, which really, I think, leads us to the point that I made in our client email this week, is that we are not going to make any knee-jerk reactions to this market volatility, to policy decisions, because these are still evolving events. And to make decisions in the middle of what's unfolding will probably not lead to the best outcomes. So instead of making allocation changes to portfolios, what we have decided to do moving forward with our client accounts in the near term is, while we are giving our investment accounts the opportunity to, as we say, rehabilitate, for our clients that are making monthly distributions, about 2 years ago, I know it's hard to remember all the way back, but we experienced another significant downturn, more than the past 2 days when the Federal Reserve started raising interest rates. And in that environment, we were seeing losses on both sides. We were seeing the equity markets take a dive because interest rates were rising, but we were also seeing the bond market under significant pressure for the same reason. So the market value of our bonds were decreasing pretty rapidly as the Fed was increasing interest rates, I think the most rapid in history in terms of the size and speed in which it was done. We had to make a decision at that moment what to do in the portfolio. Part of our planning was to use different fixed income instruments, a fixed annuity in replacement of our bond portfolio to try to stabilize the accounts. Those still exist. We had 5-year contracts for many of our clients. They've been receiving a guaranteed rate of interest for a fixed period of time. That
4% or more.
And that was what was offered at the time. Obviously, contracts vary from then and now. But we are still in the second and a half, maybe third year for some people of those contracts. Instead of allowing them to continue to accumulate, we're going to use that 10% withdrawal corridor that the annuity allows for. And for individuals that are making monthly distributions, we're going to use that cash to meet their monthly income needs, as opposed to using their investment accounts. So we're not going to sell into a negative market, either by choice, meaning to rebalance the account, or by necessity to create income for clients. We're going to use cash that's been earning interest over the last several years, and the balance inside of those accounts will continue to earn interest. But that's how we're going to meet our client cash flow needs over the short term as we allow the market to find its level again.
Yes, I certainly think it makes a lot of sense at this point to, as I like to say, open the spigot. We're going to be with annuity contracts, especially fixed ones. Whenever you begin to make withdrawals, what happens is, if you think about like a glass of water, you pour in first part. The interest part is then added to the top of it. The IRS says if you're going to make withdrawals, you have to pull out interest first.
And that's for our after-tax, non-qualified annuities.
Exactly. So what we'll end up doing is we'll end up draining the interest out first, if we need to, and if it goes longer than, let's say, a 1-year period, per se. We would then begin to withdraw some of the principal. But at this point, we're just drawing off some of the interest. The principal, again, is protected by the insurance company through its general accounts. And so we're very comfortable making this particular recommendation for clients. And again, for them, it's a paperwork thing.
That's right. They're not going to feel it's just coming from a different account, different bank account, so to speak. We won't see any difference for tax consequences or for monthly income. We're just going to say, let's put to work part of the planning that we implemented a few years ago. It was for a different purpose at that time, but now that it's a tool in our toolbox, we're going to take advantage of it. We have quite a few texts that have come in. I do want to snag one of them before we take our break, just because it happens to be about this particular topic, which is the potential to start giving back capital may be there. Kind of seems like this is the early stages.
I don't think so.
I'm going to...
I don't really... I mean, again, I have no...
foreknowledge of what's going to happen?
Absolutely none. But
Fair.
Usually, I mean, the gauntlet's been laid. It's on the table. It's been thrown down, and we'll have to see at this point how other countries react to these tariffs. I mean, you may see the intended effect, which is to renegotiate these things. If that happens, we'll see the markets calm. But I will say one thing for our current administration: they don't sit on their hands, so you don't know.
I would just say the reasons why we're seeing a market pullback, if we look throughout history, become irrelevant, because we're always going to see corrections in the market. There's a great piece that I saw that shows every major event throughout history. You know, we could include the Kennedy assassination, tariffs back in the 1920s, all the way through, Vietnam War. So not 9/11. I would say that the individuals listening to us now, especially if you're retired and you're part of the boomer generation, you have lived through some of the most catastrophic financial pullbacks, we'll call that as a nice way of saying it, over the course of not only your working but investing and retirement careers. We can go back 2 years and look at interest rate increases. I think that was over a 20% pullback, peak to trough. We could go back to COVID. That's when we shut the entire economy down and tried to start it back up again using government money.
Almost a 40% pullback.
Right.
9/11, the markets didn't even open till, what would they close, 3 or 4 days?
Right. You've gone back to 9/11. We could go back to the financial crisis. There have been a series of events that have happened. We have always in history seen new market highs. It's taken a variety of lengths of time for those to recover, but they always put out excellent articles about what to do during market volatility. And one of the most interesting articles I saw on CNBC yesterday was that, first of all, most people recognize that the largest rallies come in bear markets after major pullbacks, and that's obvious because you've seen the largest drawdown, so you'll see the largest rise again usually. But they usually come within 15 days of the largest drawdown. So if you're trying to sit on your hands, not press the button or call your advisor to make the change, waiting a few extra days could have a magnificent impact, not only on your outlook, but on your portfolio. So most people, the goal is to buy low and sell high, but the reality is most investors end up buying high and selling low because of situations like this. You've seen worse. We'll see worse in the future, I'm sure, but each time gives us opportunities. We talked about tax harvesting. We talked about looking to use cash from other places while you're allowing your assets to rehabilitate, making knee-jerk decisions, just like Rob talked about in a different context this morning about procrastinating in filing your taxes. Making decisions in stressful situations doesn't lead to great outcomes. This would be considered a stressful situation, probably not going to be the greatest outcome if you're making those decisions right now. But with all that being said, why don't we take our first break of the hour? When we get back, we've got some excellent questions with nice variety that we will get to.
Give us a call, 314-931-5877 or 84126 from the text line, and we'll be right back.
Got gold? Get green at Jewels on Hampton. Jewels on Hampton pays the most for your precious metals, jewelry, gems, currency, antiques, and collectibles. Jewels on Hampton buys precious and semi-precious gems and stones, scrap gold, and sterling silver. Jewels on Hampton buys and sells paper money, wristwatches, and pocket watches. They even take pianos and cars. To sum up, bring your gold chains, bracelets, rings, coins, dental gold, and more to Jewels on Hampton, 4506 Hampton Avenue in St. Louis. And get green online at jewelsonhampton.com.
Jill Farmer, the weather's warming up. Is your air conditioner ready for this year? Now's a great time to call Premier Heating and Cooling to schedule a preventative maintenance check and make sure you can keep cool all season long. Of course, Premier is the oldest and most experienced American Standard customer care dealer in the St. Louis and St. Charles area. They're family-owned. They have an A rating at the Better Business Bureau, and they have financing available if it's time for you to get a new unit. They service all major heating and cooling brands of equipment, and they've been doing it for over 35 years. They take pride in their fast response time, quality workmanship, and extremely friendly staff. It's why customers like me are constantly referring new customers to Premier Heating and Cooling. You can reach them at premierheatingcooling.net or 636-916-1122.
Surprise! Your expenses this month were way higher than you expected. Also, you forgot to renew your website domain, and now you're in a bidding war.
You should see the look on your face.
At Progressive, we know small business owners don't usually like surprises because they cost you money. But a good surprise that could save you money? Getting a commercial auto quote from Progressive.
Plus, the fridge died in the break room, and now everything smells weird.
Surprise yourself. See if you can save in as little as 7 minutes at ProgressiveCommercial.com. Progressive Casualty Insurance Company and Affiliates.
Can I get serious for a moment? Something that is near and dear to my heart, and that is my front yard and taking care of your front yard. Because when you drive by someone's house and it's full of weeds, you think to yourself, oh man, it's very, very simple. You know how much I love to pretend to be a yard dork. You know what I use? Fertilome. I go to fertilome.com and I type in my zip code, and a whole host of local independent lawn and garden dealers show up. I buy the crabgrass preventer plus lawn food. It's the spring application. I get it down on my yard as soon as possible, and that greens up my yard and keeps the weeds away. So it makes me look like I know what I'm doing. But really, all I'm doing is getting Fertilome and putting it on my front yard. And that will take care of my yard for many, many, many weeks, and it go a long way to having the greenest yard in the block. So this spring, you want to green up your yard and get rid of the weeds? It all starts at Fertilome or fertilome.com.
This is Jeff Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, that you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email, jeff@jblfinancial.com, to arrange your free coaching session. Let's get started on your retirement game plan today.
Let's talk about smart choices for your money. It's Straight Talk and Retirement on the Big 550 KTRS. Here are your retirement coaches, Jeff and Aaron Lapidus.
Well, welcome back to the show. It's 9:42 here on the Big 550. We're here to answer your calls, your questions at 314-931-5877 or 84126 from the hot and heavy KTRS text line.
Very active text line today, and our next texter writes, should the beneficiary in our CD accounts be our trust or specifically named individuals? Also, will this keep the money from going through probate? Thanks.
So, depending upon where you hold the CD is going to give us part of this answer. If it's inside of your IRA account and you are married, you should make the primary beneficiary your spouse. And if the trust document is up to date and says what you'd like it to say, meaning the funds go where you'd like them to go, we would recommend utilizing your trust, putting the contingent beneficiary as the trust. If your CD is held inside of a joint account, my question first would be, why isn't the joint account titled as the trust? It's okay if it's not, but then the joint account's TOD or beneficiary, which it really just called a TOD in this instance, I would make it, the trust. You created that document for a reason. You'd like it to pass through, you'd like your wishes to be upheld in order for the trust to have control of the asset when you and your spouse are gone. The asset needs to be directed to the trust. The way it is done is through beneficiary designation or TOD designation or titling. So you have a few options. I think the only other thing that I would caveat this with is if you don't want those particular assets to be divided the way the trust says, you can name specific individuals or other entities. Like if you want the CD to go to a charity, you can specifically name a charity, an individual, and that will all avoid probate. The way that you end up in probate is by either one, not having the account titled in the name of the trust, or two, not having beneficiaries or TODs on the account. That would lead to probate. Specifically designating individuals or entities to receive funds will automatically have you avoid probate.
Good answer.
And our next texter writes, true or false? Veterans get a $100 a month discount on Medicare Part A. I served 4 years in the Air Force, honorably discharged in 1982, and I'm soon to be eligible for Medicare. I do not currently use the VA.
Well, first, obviously, thank you for your service. Secondly, because you've been a working man for quite a few years, it sounds, you only need 40 quarters in order to have your Medicare Part A benefit paid for through what you've already paid in. I don't like to say things are free when you've paid for them. You just paid for it in advance through deductions in payroll over the course of your working life. So you won't pay anything for Medicare Part A. Medicare Part B is a standard premium, and usually the only way that you receive a discount is through low-income designations. Now, with veterans, you have additional benefits available to you that those of us that did not serve do not. Some are just VA benefits, which is not considered comprehensive coverage, but it is additional coverage available to you to use VA resources, either to fill prescriptions or to use VA hospitals. That usually comes at no additional cost to you. Depending upon your level of service and your designation, you may also be eligible for what is called TRICARE. If you have TRICARE eligibility, that is considered comprehensive coverage and generally also has no additional cost to you, which can provide you with additional benefits. Unfortunately, I have never heard specifically of a $100 discount on anything. But if you find out that's the case, as you are enrolling for your benefits, please let us know so we can let other veterans know that. But at the moment, I'm going to deem that one unfortunately false.
Fact-checked by real American patriots and found to be false. And our next texter is more of a comment, and he writes, not sure I would call Trump irrelevant yet. He's going to be there for at least 4 more years. I love the at least part.
At least. I would never say that a president is irrelevant, but what I would say is that specifically when we discuss presidencies over the past, when we look at investment returns in our indexes, there is a less than a 1% difference between Republicans and Democrats in terms of returns. So although the presidency can help and hurt the market, I would say that in the long term, we don't see that play out in the math. I think do we have one more text?
We do, and our texter writes, love your show, and while I agree with your general approach, however, I think you get in trouble when you compare this to history. This is self-imposed.
Okay. Totally, absolutely appreciate the comments. I think that maybe this would be a good opportunity for us to just say we're not here or qualified to comment on public policy. What our role is to help many listeners that like to take our general advice, and also specifically our clients who pay us for advice, to help them navigate the environment in which we are in. When we're talking about market drawdowns, I can say that when we attempt to say this is nothing like the past, we get into trouble because the market it doesn't act predictably, but when we look back historically, that's why we can look at charts. They tell us patterns. They tell us things about what may or may not happen down the line. Our goal is to react with calm and measured decisions in the best interest of the clients, taking into account not just what the current environment is, but what past investing experience tells us. So.
And our next texter writes, can you explain the difference between a will and a trust? Why is a trust necessary?
Dad, this is one of your faves.
Okay. So a trust, a living trust, is a document that is created right next to your will. Okay?
So in tandem?
In tandem. And so the purpose of this trust is to title assets, hold assets during your lifetime so that at your death they will bypass the probate process. Anything titled in the name of the trust will bypass probate. Now, where does your will come involved here? Well, what happens is most people don't realize that the living trust doesn't work anymore if you're not alive.
It's called in vivo, right?
Right, inter vivos trust, right, during lifetimes. What happens is at death, post-mortem, your will creates a trust document to hold assets after your death. If you're the surviving spouse of a trust, same as a joint trust, you and your spouse, a new trust has to be created to hold those assets. So the trust that you're creating now doesn't really continue to go on after your death. That's something that you should know. So and the real purpose of your will is to deal with all the assets that are not held in a trust. If you don't have a trust, it's basically to have everything. And number two is to have these two branches: your durable power of attorney. Mm-hmm. So if you're unable to, continue on your financial objectives because you're incapacitated, someone will carry those on for you. Or B, medical directives, so that same thing, if you can't carry on because of medical issues, someone else will make those decisions for you. Those are part of a will. They're not a part of your trust. So your trust is created during life to bypass probate. That's it.
Also, the trust in life, doesn't that also create some creditor protection?
No.
No, that's only after death. Okay.
That's correct. And your IRAs obviously have creditor protection while you're alive.
And your 401ks retirement accounts have creditor protection.
That's correct.
If your will and your beneficiary documents are in conflict, say, the beneficiary documents will take precedent over the will?
Yes, because the beneficiaries are considered, the beneficiary designation in the document you're signing is considered a legal document. So if you have a trust and you've named other people as beneficiaries, your trust will be a dry trust, which is why Aaron was mentioning is that with retirement accounts, typically if you have a spouse, you name them as the primary beneficiary so that they can then control those assets during their life. And if they predecease you, you name your trust a contingent beneficiary so that those assets will then flow into the trust, then be distributed based upon your wishes.
I always like how you describe the trust itself as a vessel. While you're alive, it's holding things. Maybe it's holding your house, your cars, your joint accounts if you're married, so after-tax assets. And then when you both pass away, all of that gets poured into a new vessel. And all of your other assets have to be directed into that vessel. And the way that you do that is through beneficiary designations. So you had stuff inside of the original vessel, and then you had IRA assets, other things outside of it. In order for those other assets to end up in the same vessel, you have to direct them there, or the trust doesn't control them.
Well, that's right. And I think the point Rob was hoping for me to get to, which I didn't get to, I apologize, Rob, is that your will can say, well, I leave this to Mary and this to Sally and this to Andy. Well, guess what? If your beneficiary of these accounts go to other people, the beneficiaries are the plan sponsors, the people that are the custodians of those accounts are basically controlled by the beneficiary designations, not by your will.
So either you want to make sure they are lined up, or that you have deliberately made adjustments to the beneficiary designations, directing them away from other documents.
And we've discussed this before, and this is something that we feel is extremely important. And so every 2 years, we go through a process with our clients where we're checking their beneficiaries, making sure they are who they want them to be in the percentages that they want, titled and or going to the place that they want, so that we're up to date. And then obviously we meet with them often to stay up to date so that as they are adding new people to their family, as they're kicking some out, which occasionally happens, right? This is strange. What we're doing is we're modifying those documents. And the cool part is there's no charge. Beneficiary designations will continue until the time you decide to change them. But for us to make those changes for you, which you are signing off on, no charge. So it's all good.
You have a very succinct way of explaining trust documents, and if you don't trust, you may need a trust. And that always stuck with me because it's funny, but it's very true.
And that's really because your trust will give you more latitude as to how, when, where, for what purpose your assets are distributed, to whom, for what benefit, whereas most beneficiary designations or TOD designations on after-tax accounts only allow for the designation of a person, an entity, and a percentage of that account. So if you trust your beneficiaries to receive potentially large sums of money with no strings attached or stipulations, then maybe you might not be a person that needs a trust. But if you would like to exert additional control over the division of those assets after you are no longer with us, then having a trust might be one of the reasons that having a trust is an important part of your estate plan.
Well, yes, and obviously the other point would be is that if you have someone that's either unable to manage those assets because of their age or because of mental or health capacity, you need to have a trust. And what we also need to do is to trust on break number 2 of the hour, right?
No, we have 2 more minutes to go. We're just going to push this till the end.
I love that. It's great to own the time.
Isn't it?
Life is good.
And
again, I was going to say our phone lines are open. We'd love to hear from you, 314-931-5877 or 84126 from the text line.
Great question. Texter writes, what percentage of my retirement income should be guaranteed incomes, pensions, Social Security, income annuities, etc., versus drawing down assets from accounts that can fluctuate? And we've certainly seen a lot of fluctuations this week. Great question.
Well, I think that we have found that generally folks usually like to have anywhere from 50 to 100%.
Certainly, and I think that...
I think that's just fair. They like 50 to 100% of their income to be not subject to market risk. Now, is that possible? The answer is maybe.
Right.
But if nothing else, what we certainly can do is to get that percentage closer to or into a comfort zone for them.
Right.
And that's what we can plan to do. We certainly do have the tools and the vehicles to do that. And a time like now where we're seeing market
fluctuations,
declines, if you want to call it that way, we're having other fixed income sources other than Social Security certainly can be comforting. It also gives you the opportunity to let the circus walk by, okay, and
that's a good one.
Get re-engaged later.
And I would just say that to answer this question from the beginning is you always want to consider the fact that Social Security and potentially if you have the option to have you have the ability to access pension, that's part of your fixed income. So we build on top of that. And I think a lot of the literature leaves out one of the most important bases of retirement planning, which is Social Security income. We heard from another texter can make up $70,000 a year between spouses. So that is not insignificant. What else isn't insignificant is holding through the break, because when we get back, we'll be here to talk more straight talk on retirement.
Hi, it's David Sherwood of the Inside Out Show and president of Sherwood's Forest on Barrett Station Road, just south of Manchester. Spring planting season is here now. We are fully stocked with the area's largest selection of flowering trees, Japanese maples, evergreens, and shade trees. Choose from dogwoods, redbuds, magnolias, and cherries to provide springtime fragrance and blooms. At Sherwood's Forest, you'll also find hundreds of green giants and junipers to screen thy neighbor. Enjoy the beauty of spring-blooming shrubs like azaleas, lilacs, viburnums, and large blooming perennials like Helleborus. We use Espoma's Biotone Starter Plus in all of our plantings. So head to the forest, Sherwood's Forest, 2651 Barrett Station Road, or check out our inventory at sherwoods-forest.com. Sherwood's Forest is open 7 days a week.
Home and garden showplace, making beautiful gardens come alive.
Hey, it's Heidi, and I feel very lucky to love where I live. And I know Lauren Risley feels the same. And her team at Lauren Risley Realty wants you to experience that same great feeling. One of their mottos at Lauren Risley Realty is love where you live or move. Dream homes are their specialty. Actually, they do a lot of things right, because when you buy or sell a home, it's not just a transaction. What the Lauren Risley team does is build relationships, and I've seen that firsthand. So if you have plans to buy, sell, invest, or just have a question about any of it, call Lauren Risley Realty, 314-775-0684. That's 314-775-0684. You can also email Lauren at hello@laurenrisleyrealty.com.
KTRS St. Louis, Alton, Valley Park, St. Charles, and the...
Let's talk about smart choices for your money. It's Straight Talk and Retirement on the Big 550 KTRS. Here are your retirement coaches, Jeff and Aaron Lapidus.
Well, welcome back, everyone, to hour number 2 of Straight Talk on Retirement.
A subject a little bit less volatile, because you care. We talk Medicare.
Everybody needs it eventually.
I wish we could get on it.
Right? I think that's the biggest tragedy. We have to wait till 65 to get access to Medicare.
I never really paid much mind to the, Medicare for all arguments because I thought they were ridiculous. But then I took a look at some of these Advantage plans and I was like, whoa, wait a minute. Maybe they have a point.
Oh, not Medicare for all, just Medicare for you.
No, well, I mean, you don't want the deficit to explode anymore, do you? Just add me.
Just the one. How about let's talk a little bit about Kim?
Let's. Kim is a new client that just turned 60, that will be turning 65 on May 18th and has enjoyed working as a nurse for most of her career. After having a financial coaching session and planning out her cash flow game plan, she set up an appointment to talk about Medicare and asked what needs to be done when she turns 65 in May. We were able to review notes from her financial coaching session and confirm that she would not be taking Social Security until turning 67, which is not uncommon. Kim also mentioned that she would like to spend more than half of her time between St. Louis and Chicago, where she has some family, which, again, is not uncommon. A lot of people do some traveling in retirement.
Certainly, and maybe a specific destination, which is nice that Kim kind of already knows where she's going to be. But this is kind of a normal part of our process in terms of working with individuals both on the financial and the Medicare side of things, which is, Kim originally came to us for some retirement planning, and we were able to not only plan out her cash flow, but plan out that retirement goal of hers. And then we sent her over to deal with to you and Frank to talk about Medicare.
Absolutely. And, we like to be full service, and Medicare enrollment and onboarding, it seems like a small thing, but it really isn't when it's, paramount in your mind. So, I mean, it may be only a small percentage of, your income is going to be going towards, Part B premiums or a supplement. But in your mind, it's like, what am I going to do now with healthcare? I've always had it through work, and, it can be very, very stressful, but it need not be when you stop into the office.
That's a great point. I was going to say, and also this is something that as you are approaching 65 and your friends are approaching 65, everybody has a story about enrollment or how they enrolled, what plan they selected. So we thought, since Kim was really taking it from the beginning, she's turning 65, going to enroll, that we would go through the mechanics of what to do to get on to Medicare.
I'll start with enrolling in Medicare A and B. The easiest way is to set up an account at SSA.gov.
So, SSA.gov is the Social Security Administration's website. Medicare and Social Security are tied together, but that does not mean they are a requirement of one another. So just like Rob mentioned, Kim needs Medicare, but she is not going to take her Social Security yet. That's part of our game plan, is to have her wait. But she still needs an SSA.gov account in order to apply for Medicare.
And if you don't have an account, creating one is very easy. You can just log right on, enter in your demographics, username and such, create your account, and there you go. Or if you'd like, you could call your local Social Security office to schedule an appointment, or you could go and try and schedule an appointment down at I would suggest calling first to set the appointment before just showing up there.
And also, showing up to the Social Security Administration office is never a good idea, because in many cases they have limited the actions that they will assist you with in person after COVID. That's very limited. So our recommendation is go ahead and attempt the online process. If you're working with us, we have a step-by-step for you that just kind of, I like to call it the roadmap, because it just lets you know you're in the right place, you're filling out the right information. You can do it online. I mean, you can do it over the phone, but like Rob said, the fastest way to get there is to just apply online. Social Security Administration's website is going to give you two options. You can apply for Social Security and Medicare at the same time if that's your choice. In Kim's situation, we're going to say apply for Medicare only. So she won't receive any Social Security benefits simply by enrolling in her Medicare Part A and B. This is specific to someone turning 65. Because if you are over the age of 65, we're going to have a little bit different of a game plan for you in terms of enrolling in Medicare. It isn't any more complicated. It's just a little different. But let's get back to Kim. So she's going to go online, enroll in her Medicare Part A and B benefit, and then what?
When does Medicare start?
That's a great question that Kim asked us. When does this actually begin? So she was born on May 18th.
On the first of your birth month, unless you're born on the first of the month in which it will start on the first of the prior month.
So Medicare gives you a little bonus. If you were born any day, so the 2nd through the 31st of a month, your Medicare benefits will begin the 1st of that month. So in Kim's example, May 1st is when her benefits would begin. But if you are someone that was born on the 1st of a month, you get a whole month at no extra charge. Well, you have to pay your Medicare Part B premium, but you get a whole month even though you haven't turned 65 yet. So if Kim had been born on May 1st, her benefit would actually be able to begin on April 1st.
Which is a great anxiety reliever because, mechanically, people get very, and it's not unreasonable because, again, you've had health insurance through your employer the whole time. So, if you had any questions, comments, you just went to the HR department, but now it kind of feels like you're on your own, but you're not, and you don't have to be.
That's a great point. So Kim's got her Medicare Part A, B benefit. She knows it's going to start the 1st of the month that she was born, so we're going to start at May 1st. How do we fill that gap for Kim? So we know that Medicare Part A and B cover 80% of your medical expenses. So if you take just straight Medicare with no supplement or Medicare Advantage plan, you have an 80-20 policy, 80% covered by Medicare, 20% covered by you. No top-end protection, which means the bills will and can be endless.
Unlimited, could be.
Exactly. And you have no prescription drug coverage. So how do we fill the 20% gap and our lack of prescription drug coverage for Kim?
We're going to need a Medigap plan, also known as a supplement plan.
Or a Medicare Advantage plan, but Kim, I guess you all decided Kim walked down the Medigap road.
She wants to try that first.
Okay.
And, it's not unreasonable to see, what a Medigap plan will offer. And, no option is foreclosed to you if you originally come onto a Medigap or supplement plan and you decide after a year, like, hey, I'm really not consuming health care in a way that justifies the added expense. The Medicare Advantage option is always there.
Open.
Exactly.
So if you are looking at Medigap policies or supplements, those lettered options, there are 12.
Yes.
You've got 12 choices.
C and F are no longer available unless you've had Medicare prior to 2020, so that you'd be grandfathered in if you had prior to, but if you weren't,
so for most people turning 60, for everyone turning 65,
those plans are
not available. But that's okay.
Because Plan G is the most comprehensive in terms of how much it covers and the most affordable for the coverage you can get.
So what does Plan G cover? Covers everything but your Part B deductible. What is the 2025 Part B deductible?
$185 a month.
No, that's the premium. What's the Part B deductible?
$257.
$257. All right, so what that looks like in practice is Kim goes to Mary Care doctor for an annual checkup. That's covered under Medicare, no extra charge to her, so she doesn't owe anything if she's on a supplement or on a Medicare Advantage plan. But now Kim goes to a specialist during the course of the year, and the charge is $85. She's going to pay $85 out of pocket against that $257 Part B deductible.
And when she hits that $257 Part B deductible?
Done paying for the rest of the year.
Absolutely.
So the way I like to say it is first few visits to the doctor, labs, x-rays, maybe you need a procedure. You're going to pay $257 out of pocket, And then for anything else that's medically related that is covered under Medicare and not your prescriptions, you have no additional liability. Your monthly premium will cover all of your additional expenses because that is the contract that you signed with the insurance company under a Plan G supplement.
And just looking at the numbers for the Plan G for Kim, the supplement itself is $190. Like you said, she has to first satisfy that deductible of $257. So we understand and know up front what these costs are going to be going forward.
That's right. So if we take the $190 over 12 months, we know that's $2,280. If Kim meets the Part B deductible, that's $257. So that means her liability for the whole year is $2,537. That doesn't include prescription drug coverage, nor does it include prescription drug copays. But that essentially covers all of the medical side of Kim's coverage.
Absolutely. And, if she wanted to try and cut down on those prices a little bit, the Plan N, which isn't as comprehensive but still fairly comprehensive, is only $140 a month. You still have that $257 deductible, but she would pay $20 copays for doctor visits, $50 for ERs, and excess charges can be charged. Doesn't mean they will, but they can.
So the Plan N has become increasingly popular over time, and the reason for that is, right now there's about a $600 savings for Kim annually in terms of premium. So just like the math that we use with Medicare Advantage plans when we say, are you really going to spend that full supplement premium every year on your care, or can we bank some of that for a year where you actually will spend it? We can use that same logic, which is if we know that Kim is going to save $600 in premium right off the bat, we can set the $257 Part B deductible to the side because you would pay that with Plan G.
Does not make a difference.
Exactly. You're going to pay it with Plan N. But now we're going to add in copays to the doctor and potentially copay to the ER.
So how many copays are we looking at to get beyond the $600, and how many trips to the ER? Are we going to have to compound on top of that?
Perfect. 600 divided by 20 is 30. So that means we would need 30 visits to a specialist in order to meet that $600 deductible. And then obviously you would need 12 ER trips.
So that's once a month.
So, or some combination therein.
Right.
So you can see that you have access to quite a bit of services, 30 doctor visits, 12 ER visits before you hit that differential between the premiums that you would have paid under Plan G and that you are not paying under Plan N. So in many people's cases, a Plan N might be a great option. It does create some variability, though, because you don't know how many times you're going to the doctor.
Correct.
Now, the last piece of that is they're called Part B excess charges that are not covered under Plan N. This does seem like and can open up additional liability to you. What Part B excess charges are when Medicare, your provider, and the plan do not agree on what the bill should be. Medicare is allowed to charge what's called an excess charge, which means the plan you chose is not covering it. Medicare itself and the provider is saying my service is more valuable than what you are deeming it to be, so Medicare is going to charge an excess to cover that for you. Part B excess charges are relatively rare in our current environment. It is something to consider, though, and why Plan N is less popular than Plan G.
And what did we decide for Kim? Well, Kim ultimately decided to go with a Plan G. She was looking for the most comprehensive coverage she can find, and she wasn't really concerned about the monthly premiums as much as she was concerned about in case anything were to happen. She would be 100% covered, and that's a great thing.
That is, some people really prefer certainty to variability, especially when it comes to sometimes things that can be stressful, like health insurance expenses. We don't think about healthcare costs unless we aren't well. So when you're not well, that's usually a time of higher stress. So what I like to say is many people ask, why would anyone choose a supplement now? The Medicare Advantage plans are great, etc. I would say this is one of the top reasons that I see people electing the supplemental plans is to create almost 100% certainty in what you are going to pay. Just like we did with Kim, we took the Medicare, we took the monthly supplement premium, multiplied it by 12, added the $257 up, and that is how much she's going to owe. If we wanted to delve even deeper, which we do in the office, we weren't going to do that during the showbiz of this morning, but we could add in what is the premium for the Part D prescription drug coverage. For Kim, it was no cost. She's not on any meds right now, which means she didn't have to worry about co-pays either at the moment. But when you're in the office with Frank and Rob, they'll be able to say, well, we know you're on these 2 meds. If you continue on these 2 meds at this rate, filling them the same way you have over the last several years, we can also tell you exactly how much you're going to spend.
Absolutely. And, you really can't put a price tag on peace of mind. And for many people, knowing up front, like this is what it's going to cost, there are going to be no surprises, that's kind of invaluable.
Absolutely. We've got our first Medicare question of the day. I was remiss. I should have said, if you have Medicare or any health insurance question, you can always give us a call, 314-931-5877, or send us a text, 84126, on the text line.
And before we get to a text, I just want to say as an aside, it makes no difference what plan. We want to put you in the plan that is right for you,
right.
And we always work back our formula. Who are you seeing? What are you taking? And are there any medical events that are coming up that we need to be aware of, as we navigate what plan might be right for you?
And the way that we get all of that information in advance is when you give us a call or send us an email to set up a Medicare coaching session. Kelly, our office manager, is going to send you a medical questionnaire, and it asks exactly what Rob mentioned. Who are you seeing? What prescriptions are you taking? And do you have anything else to tell us or that you'd like us to know? So that could be, like Kim mentioned, she's going to split her time between 2 places. That can be valuable information for us when we're helping you make a decision. Or I have a knee replacement coming up. I'm thinking about a hip replacement, whatever the case is, or I'm currently undergoing treatment for something. If you let us know some additional information, then we can continue to attempt to tailor your medical plan with your medical care or your medical needs.
And, just putting a fine point on that, we just wrapped up open enrollment, and, I received quite a few inquiries about, hey, I'm looking to have a major dental work done, or I may have to have a major dental work done. What Advantage plan will offer me the best, most robust dental benefit? But again, knowing what front-running medical or dental or vision or hearing issues you may have or foresee in the future will be of great benefit when we try and figure out what plan is best for you. So the more we know, the more we can guide you in making the right decision.
Right. And before we get to our text, we did have one enrollment period just end March 31st where everyone on Medicare Advantage plans had the opportunity to make switches if they felt that they didn't have that chance during the annual enrollment period at the end of last year. However, in Missouri, there are still a few election periods open. They're called special election periods, and they are based on disasters. So because we had some severe weather over the last several months, there are some election periods open for individuals. So if you're still someone that's potentially struggling against your plan, reach out to your agent or reach out to Frank at our office, 314-863-0008. Don't just wait until you think it's time to make a change. Reach out to a professional, and if they what I always like to say is, if we can help you make a change that'll make things better, we're going to do that. If we can't make the change for you, maybe there's a way that we can help you alleviate whatever the pain point is. For example, if you're having trouble with referrals, or if you're having trouble getting that reimbursement on the dental, reach out to someone like Frank, the person that you originally worked with. Don't just wait, because there are often things that can be done to help you either fall back in love with the plan or just deal with the plan over the next few months until you can make a switch.
Never costs anything to sit down with Frank or myself. It'll only cost you something if you don't,
Exactly.
as I like to say.
Yep.
And, it doesn't just end with onboarding you or choosing a plan every year when open enrollment, through the year you may get bills, you may get statements that you don't quite understand. It's always nice to be able to reach out to someone who's not going to have you sitting on hold for 15, 20, or 30 minutes, who's going to get back to you in a timely manner and going to address your questions and concerns in a way that you understand.
And at least you'll get one answer instead of several, which can happen.
Exactly. And getting to our texter writes, I have homes in Arizona and Missouri. I am an Arizona resident spending 8 months in Arizona. Where do I apply for Medicare? Turn 65 in January.
So you're going to apply. Medicare is a federal program, so you're just going to apply, just like we talked about with Kim, online through socialsecurityadministration.gov. Your A and B benefits, they come to you and are the same regardless of what state you live in. However, because you are an Arizona resident, you're going to want to apply for either a supplement or a Medicare Advantage plan that is based in the county in which you live in Arizona. That's where it's going to be tied. If you move, if you change residencies, that's going to give you the opportunity to change plans. Again, there's no medical underwriting to do that. However, if you apply for a plan that is not in your state of residency, they're not going to allow the enrollment because you don't qualify. But there are Medicare Advantage plans in Arizona. There are also all of the supplements, because they are federally standardized. You have access to all of the supplements in Arizona as well. It's just that the companies that offer those supplements will and do vary. That's it.
Absolutely.
Interestingly enough, I'm sort of faced with this question about residency as well, because I've just...
No.
Yep.
No Florida residency for you.
I got to stay in Missouri?
We love sunny Florida for many reasons, but their medical benefits are not one of them.
Yeah, I did a little digging for my dad.
So, right.
And it was, I think that the St. Louis metro area has some of the most competitive, most robust Advantage plans that I've seen, and I've done some deep diving for him in the Northeast and the Southeast.
I was going to say, so Papa Markham, as I affectionately call him, has multiple choices. New York, Florida, or we're trying to get Missouri on the list. And of the three, Missouri, Rob, I won't steal the thunder here.
It's not even close. I mean, some of these Advantage plans are, especially in the Northeast, max out-of-pockets. Here we're averaging between $2,500 and $3,500. There, twice, sometimes 3 times that amount. And so, it's just it's stark and it's notable. And when I was running my father through it, it was all
the more reason
right.
to be in St. Louis.
This is part of the hook that we have to use to get him here. But I was startled. But look, different markets are going to have different products, and we just are blessed to live in the best part of the country.
Well, I got a question for you, honey, on that respect.
Yep.
Since I have to push the envelope a little bit here.
Yep.
I was having lunch with one of our clients while I was in Florida.
Yes.
And they mentioned to me that the husband had changed his residency to the state of Florida.
Yes.
But his spouse
hadn't.
Yeah,
it creates for a lot of interesting paperwork on the financial side of things, yes.
Understood.
Mm-hmm.
But the question is, I'm in Missouri and then take up Florida for us?
The answer to that is yes, but my answer is no. There's nothing that says you can't do that, but you're doing that because of income tax.
Yes. Significant amount of income taxes.
Well, we can rectify that in other ways.
Okay, I'll take a bonus.
No, bonuses are taxed the same, you know that, but pay reductions
Not bonus.
create less taxes.
I meant bonus on the bonus, honey. It's like they call it a double bonus.
Oh, a mega bonus?
It's like a dad bonus, right?
I thought I was the dad bonus.
Well, unfortunately, you're not a dad, so...
I meant like me being alive creates the dad bonus.
I gotcha.
No.
Nah.
I mean...
Our phone lines are open. We'd love to hear from you. 314-931-5877 or 84126 from the KTRS text line.
I think that you pose an interesting point because we can clue the textures in a little bit. If we're comparing a high-usage individual in terms of medical care and also their needs and desire for specific physicians, I would lean towards what Rob has said, and the St. Louis or metro area, so Missouri, Illinois plans are going to far exceed Florida. But if we have to offset a consideration for savings on income taxes, we can do the same math, which is what's the difference in the maximum amount of pocket versus what you are going to save in terms of income taxes. And because Aetna and United Healthcare do have plans in both Missouri and in Florida, you would still have access to many of the same physicians that you have here if you wanted to be able to transport your plan back and forth. So sounds like we would have to do a little bit of work on that, but I would imagine that your income tax savings would be more than $5,000.
Oh, yeah.
So then it might make sense to do that. However, I think that your tax preparer mom might charge extra for having to deal with multiple returns.
Yes. Always a possibility.
Fair enough.
Very good. Do we have more text? Or are we going to take our first break of the hour?
Let's take our first break.
So don't touch that dial. We'll be back with more Straight Talk on Retirement right after these brief messages.
You have a tax refund coming this year, and are you ready for some new flooring? Why not shop the city and save at JJS Flooring? JJS offers a wide variety of options that will surely meet your flooring needs. See the Ultra Soft Carpet from Stanton, truly the softest carpet on the market, and it's backed by the legendary Stainmaster warranty. Stop by and see them at 2301 Gravois Avenue, just west of Hodax, or give them a call at 314-772-3996. JJS has over 40 years of experience in residential and commercial settings, as well as home rehabbers and builders. Why shop the big box stores when you can get personal service, second to none in quality products, and a team of professionals dedicated to your flooring needs? JJS is an A-plus rated member with the Better Business Bureau, and their service far exceeds the competition. JJS offers financing options as well to help make those flooring decisions just a little bit easier. So stop by today. See what you can do at JJS and see what JJS can do for you. JJS, their service will floor you.
Look at our alums, the contributions that they have made throughout industries in the St. Louis region.
Terry Freerks, a graduate of the University of Missouri, St. Louis.
UMSL is embedded in the fabric of the St. Louis community. We're hands-on, and when our students graduate, they are definitely career ready, but maybe more importantly, they're career confident.
More is what moves us. Find your more at more.umsl.edu.
This is Erin Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email at aaron@jblfinancial.com to arrange your free coaching session. Let's get started on your retirement game plan today.
Now, back to Straight Talk on Retirement on the Big 550 KTRS. Here are Jeff and Aaron Lapidus.
10:35 here on the Big 550. Welcome back to hour number 2. It's already halfway over of Straight Talk on Retirement. We'd love to hear from you, 314-931-5877 or 84126 from the text line. Kiddies, do we have any text to clean up here?
We don't. For
If
the
not,
moment, we've...
If not, then let's do a little fun with Phil.
Absolutely. And we received an email from Phil, and Phil writes, I am 66, married, and was planning to retire at the end of this year. At the end of last year, I had $1.6 million in my 401k plan. Today, it is $1.4 million. I am confident that
Was that on Thursday or Friday?
We don't want to. Do we want to ask?
Fair enough. Continue.
All right. I am confident that I will need to draw money from my retirement assets to supplement my Social Security benefits. Here's how it breaks down. He has 1.35 million in a pre-tax 401k, and he has $50,000 in a Roth 401k.
Very nice.
And it looks like he's got a lot of questions.
They always do.
Question number 1. My current asset mix is growth-oriented, about 75% equities and 25% bonds and cash. The recent market declines have reduced my exposure to stocks. Should I do more today? So I guess he wrote this email on Thursday in anticipation of Friday.
Yes.
Okay.
And so I would say the answer is no. I think what's happened is the market has obviously rebalanced your portfolio a little bit. You're right now in what I would consider to be a moderately not aggressive, but I would say moderate mix.
It's aggressively moderate,
which is cool. I wouldn't make a change today whatsoever. I think that sounds very good. Second question was, how are pre-tax and after-tax contributions, are they treated differently? The answer is, of course they are.
Yes. The great news is you already paid taxes on the money inside of that Roth account before you made the contribution. So when you initiate your rollover, instead of rolling everything into one account, it looks like it's in one account right now. It's really in two. So when you initiate that rollover, we want to keep them in two separate accounts. The pre-tax of the $1.35 million, we want that to go into a traditional IRA because you haven't paid taxes on that money yet, and the traditional IRA will reflect that. But with the Roth 401k, we want that to go into a Roth IRA because that will reflect that you've already paid the taxes on the contributions, so we can continue to allow your contributions to grow tax deferred. And when we start to pull that money out, it won't be taxable for you.
Definitely do not want to commingle your pre-tax and after-tax contributions.
Right, because either one, you have to pay an accountant to keep track of that and parse it out for you, or two, you just made the money you paid taxes on taxable again. Before we get to our next question, we have a caller on the line.
Good morning, Dan.
Yes, I was wondering, it's a little different than regular investments, but if you were buying a second home for an investment and it's in foreclosure, what do you look for?
Cover.
Dad.
I'm just kidding. Are we assuming that you're are you trying to purchase a foreclosure?
I would be interested in buying a house that's in foreclosure now, yeah.
Okay. So, again, I think really you need to think about two things. Number one is obviously the indebtedness that you have to get this thing out. Right. And number two is the timing. My understanding is these transactions take a lot longer than is expected because you have a lot of parties that have to sign off on the agreement that, especially the banks,
right,
on the prices. So that's pretty much what I would certainly consider. At the same time, are you going to be using this as a rental property or as a second home?
Maybe just a flip.
Okay. So that's fine. So if you flip it fast enough, then you're only going to look at, obviously short-term capital gains, which would be ordinary income.
Right.
You may have some, if you hold it more than a year, you're probably going to depreciate the property, so therefore you have a little recapture to deal with.
Yeah, it would be less than a year probably.
That's cool. So, again, I think I think the problem that you're most likely going to face more than anything else is the time it takes to make this transaction happen.
Mm-hmm.
So I hope that helps.
Okay, I appreciate it.
You're welcome.
Thank you.
I have a couple questions just out of curiosity.
Sure, babe.
I guess that's why you always have questions.
Sure.
Which is, since if you're purchasing something in foreclosure, you have to pay back taxes or whatever it was to get it out.
In indebtedness, maybe.
Okay. Is that part of your basis?
Yes.
So you get to add that to your basis. So you buy the foreclosed property for $50,000, but you had to pay $10,000 in back taxes. It is now $60,000.
Cost basis is $60,000.
Yes.
Okay, interesting. Just curious. And then are there any tools, and I don't know if you would know this, are there any tools that people can use to check on everything about the property before they decide to make the purchase, like liens or other taxes or other indebtedness that you mentioned, so they know before stepping into something like that? Because it seems like
you don't want to get hit with a surprise.
Right.
You know what I mean? Like you think you satisfied all the indebtedness and the back taxes, what have you, and then all of a sudden there was
something came out of the woodwork.
Right, something fell on your head.
Again, I've never done one of these, but we know that when you're purchasing any property, you're usually involving a title company who's searching the title, and they're providing you with information on that. Certainly, you can always go to something like Zillow.
Right, look up things.
And see the transaction history. But again, using a realtor might be something smart to do.
Someone who's had experience in purchasing or selling or looking to help sell foreclosed properties.
Or a real estate attorney, one of the two. It's always good to lean on a professional if you can, especially in times of uncertainty. And the other thing is, it could be a great training aid for you if you're a do-it-yourselfer, right? You pay the first time.
And then you know what to look for in the future, what the process is for looking for things.
Absolutely.
That's a great point.
Right. Don't be cheap. I mean,
well, it costs you in the end in a lot of cases.
Well, it was interesting because I was having a conversation, about a month or so ago with somebody who was having difficulty with their parents. Unfortunately, illness, etc. And do we go to assisted living? Do we go to nursing home, et cetera, that type of care? And what I always suggest is that when you feel like you're in that situation, and especially if you're really concerned about asset protection, especially among you and possibly your siblings, you need to, instead of going to free resources that are available, so theoretical free resources always have hooks to them. Okay, somebody wants to sell you something.
Certainly.
But I would certainly say, this is the time that you reach out to a professional, which is an elder attorney.
Right. It's a defined part of the specialty of law called elder care or elder attorneys that can assist you in this with this.
Yeah, and most of them also can take you to not only talk about this is the process, but also if you're concerned about spend down. It's really their job to help you get ready for it.
They usually call that asset preservation.
Exactly, and whether you need a trust or it's just going to be a spend-down situation, and really how are you going to, if need be, apply for an application to Medicaid. I mean, a lot of attorneys, and by the way, we have a ton of incredibly capable, trustworthy, they do a really good job, attorneys on this side of the river, on the other side of the river, in St. Charles, et cetera, that we've worked with.
Yep, we've worked with a variety of attorneys in this area.
And this is one of those things where, it's not like your taxes, like, I don't have anything to worry about, I'm going to use TurboTax. I mean, it's not that simple. And you really, and especially if you have other things like veterans benefits that could be involved, you really need to have somebody that has had that breadth of experience that can talk you through this and really get you ready, because when you want to get a hold of somebody else's money, and I'm talking about the state,
right,
where they're coming in especially and getting involved in helping pay for whether it's assisted living or nursing care or whatever it would be, those charges. You want to get, you have you have a waiting period, typically 90 days. It's going to be yours or that person's, but you want the money to come in at the right time. So using an expert here to help you with this can be invaluable.
I would say this is a perfect example of it's the things that you don't know that these specialists are going to be able to assist you with, because this is even something that we do not specialize in terms of Medicaid applications, spend down. Obviously, we need to know the general rules, but then when our client, or it's usually the parents of our clients at this particular point, right, need this assistance, we are referring them to elder care attorneys to assist, because they do this is what they do all day, every day, working with clients in order to either create asset protection if they've had enough advance notice, or to be able to help the most effective way to do the sped down, because not only are there rules, but there are efficient ways and inefficient ways to do this, and that's what they're going to be there to help. And the ultimate goal is to get you to where you want to go the fastest, least expensive, most efficient way possible. That also, if you're now the caregiver, or you are trying to be the caregiver to your parents, you've got a lot of other things to think about. This is something where they can really help with the nuts and bolts.
You certainly don't want to be penny wise and dollar foolish, and reaching out to a professional in any regard can never hurt you. Can only help, because there's, like you said, there's many things you don't know, and if you don't know where the holes are, you're more likely to fall into one.
Right.
And really what happens at the end, we've been through this a few times with clients. The attorney is really creating the game plan, and because we're the financial advisors, we're executing that plan for them in the most efficient way that we certainly can, and obviously working very closely with them. But you guys listen to us every week. We knew a lot of stuff. We know a lot of the rules, but when it comes to the legal side of this, you need an attorney. That's what it's all about.
That is what it's all about. And I think before we get back to Phil, because he's got quite a few more questions, why don't we take our second break of the hour?
Let's do that, and we'll have more fun with Phil when we get right back after these messages.
The storms are back, the wind, the hail, the damage to the roof. And when the roof gets damaged, who do you call? You call John Bill Roofing. But the storms are back. You know who else follows the storms? The storm chasers. These are the teams of people who come and leave a note on your door, mailbox, maybe your windshield wiper, and they tell you to call, and you think you're getting a deal. You give them half the money, and you never see them again. With John Bill Roofing, they've been in this business for a long time right here in St. Louis. They live, work, and play, and they guarantee you to give you the best price on your roof. When the roof gets damaged, your first phone call is to John Bill Roofing, 1-800-NEW-ROOF, 1-800-NEW-ROOF, or johnbillroofing.com. Roofing, siding, gutters, John Bill Roofing. Residential, commercial, industrial, a company you can trust, a company that lives, works, and plays right here in St. Louis. Make it local. Make it John Bill or johnbillroofing.com.
Some days, my active psoriatic arthritis makes it hard to get in the game. Now, the ball is in my court, thanks to treating my skin and joints with Skyrizi, Risankizumab Riza, a prescription-only 150-milligram injection for adults.
Nothing is everything.
Skyrizi helps with less joint pain, stiffness, swelling, and fatigue. For those who also have plaque psoriasis, 90% clearer skin is possible with just 4 doses a year after 2 starter doses.
Don't use if allergic to Skyrizi. Serious allergic reactions and an increased risk of infections or a lower ability to fight them may occur. Before treatment, your doctor should check for infection and tuberculosis. Tell your doctor if you have an infection or symptoms such as fever, sweats, chills, muscle aches, or cough, or if you plan to or recently received a vaccine.
With Skyrizi, there's nothing like clearer skin and better movement, and that means everything. Ask your doctor today about Skyrizi and visit Skyrizi.com or call 1-866-SKYRIZI to learn more.
There's plenty of economic uncertainty, inflation, tariffs, stock market correction. It's all negatively impacting your business. I'm Jill Farmer for Capital Advisory Group and Jeff Zufall, their senior tax strategist and wealth advisor and author of the #1 best-selling book on taxes, Keep What's Yours. Get some peace of mind. Call Capital Advisory Group at 636-394-5524 and ask for your tax-saving analysis. 636-394-5524. Online at capitaladvisorygrp.com.
This is Jeff Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, that you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email, jeff@jblfinancial.com, to arrange your free coaching session. Let's get started on your retirement game plan today.
Let's talk about smart choices for your money. It's Straight Talk and Retirement on the Big 550 KTRS. Here are your retirement coaches, Jeff and Aaron Lapidus.
Well, welcome back to our last segment of Straight Talk on Retirement, hour number 2. time just keeps flying. We were having some fun with Phil. Phil told us that he was married. Good for him. He had about $1.4 million in current retirement assets, of which $50,000 are in Roth. He's in a growth configuration. We would consider at this point a aggressively moderate configuration, 75-25, which is just fine. And his next question was, if I choose you and Aaron to serve as my advisors, which of course would be a privilege for us, what advice would you be giving me today? I think this is a really good question, because we're talking about he's in a situation where he has about 6 months or so, 8 months, until retirement. What we suggest to do? Well, I would certainly be suggesting, if Aaron let me, that...
I'll consider it.
Thank you. Let's stay invested.
Yeah.
As we are today. And let's look at something else here, which is... we figured out that you have enough money, based upon doing your game plan, to cash flow in retirement, which is cool. And we're going to get to that in a minute. Should we be continuing to put excess contributions into our retirement account? Should we be taking them home and increasing our emergency fund? Should we be putting them into the Roth? That would be something that I'd certainly be advising him about. And how would I change that advice once he retired? Well, the answer is probably wouldn't. We think that our clients should stay invested for the long haul. Mm-hmm. They shouldn't necessarily get more conservative than they are. They should have a mix that matches their risk tolerance. And it sounds like after doing and reviewing his questionnaire that he's in the right place.
I think that first suggestion is a great one. We didn't hear about what Phil and his wife's emergency fund looks like. In many cases, when we have clients or potential clients approaching retirement, they've done what the conventional wisdom tells them to, which is put as much as you can into your retirement accounts at work. You'll get the match. That's the best way to save for retirement. Absolutely agree. However, that sometimes creates a lack of balance, which means we see a lot of people that have, maybe they are living paycheck to paycheck in the sense that what comes in is going out. They've already made their savings contributions through payroll deduction at work, but they really aren't creating any savings outside of the 401k or 403b, whatever you might have through your employer. Maybe one of the ways that we can do that over the next 8 months or so is reducing our contribution to the match, taking home the excess to create some after-tax savings.
Yeah, and let's just say for fun, because he's got about $50,000 in his Roth, so in the Roth portion of his 401k, which means he's been
putting some in there,
putting some money in there. Does it make sense to continue to pile it into the Roth, or because that's an after-tax contribution, or really just to take it home and start to feather his nest? Because we know that in the future, most of our clients don't use their Roth accounts for income purposes. They use them for big-ticket purchase items that they want. So I was going to say, we've got a couple other questions, but instead of going to those at this particular moment, why don't we go and look at his math? Because I think his math will tell us a little bit more, right?
And Phil has an after-tax goal of $6,000 a month, and we know we have to scale that up to include taxes, so that's going to give us a monthly goal of $7,200 a month. But luckily, Paul has a pretty robust Social Security benefit, which is $3,200. So the amount needed from his assets drops from $7,200 to $4,000.
Well, also $3,200 is Phil's Social Security benefit. We don't have what Phil's wife's is yet.
Yeah, and really, what was interesting is that this was a discussion about we need to replace Phil's income.
Oh, got
because
it.
His wife was actually a homemaker.
Oh, okay.
So she didn't have an income source, and she was a little bit younger, so she wasn't even eligible for Social Security benefits at this moment. So really just replacing his income, and then obviously we would have a valve adjustment when she became eligible for Social Security benefits.
Right, because she'll be eligible for at least $1,600 a month when she reaches. So that's just extra cash flow we know will eventually come in.
Makes his game plan work that much better.
Yeah.
Right. So if he needs $4,000 a month net, we know that's $48,000 a year. And using a safe withdrawal, we consider prudent withdrawal of 4%, he needs $1.2 million of assets. We know he's got 1.3, or he has more than that. He actually has
1.4.
So after that, the question then becomes, okay, so tell us the other stuff. What are other reasons or needs that you'll have in the future for large hunks of capital?
And we're talking about near-term future because, of course, our goal is that you'll be retired for 30-plus years in most cases. But we, if you decide to work with us, we're going to be meeting with you on a very regular basis so we can continue to plan out. But we really want to plan the next 24 months. Do you have additional cash flow needs that aren't wrapped up in that monthly income goal?
And in Phil's case, he had a couple of capital requirements that were going to be on the horizon. One of them was a kitchen refresher, and he has $30,000 earmarked for that. And he wants to replace his automobile in 2027, and he's earmarked about $40,000 for that expenditure. So we have to add in another, looks to be $70,000 into his game plan.
Bringing him really to a total amount of capital required. That is the income piece, or the milk money piece, as I like to call it, of 1.2 plus 70,000, 1.27 million. He's sitting at 1.4. Woohoo! He's a rock star, which is great. So again, I think just to review some of the recommendations that we've made, we certainly suggest that he maintains his current asset allocation, and he'll probably do that through his entire retirement second career. Maybe consider reducing his 401k, as Aaron was talking about, as a way to funnel more money into his emergency side fund vault, so that'll give him additional liquidity, not needing to tap his retirement income sources or his retirement plan sources.
And I would also just say, to tack onto that, given the last 2 days, for everyone that's making 401k contributions, everything just went on sale for you because you are making your dollar cost averaging into the market. For the last 24 months, you were dollar cost averaging on the way up. Everything was going up the last 2 years. Now, things have been repriced by about 10% over the last 2 days. Your next 401k contribution means theoretically, you should be able to buy 10% more with the same contribution that you made, which means as those shares rise in value, hopefully over time, that will make everything more valuable. So I would say this is a great opportunity. As long as you're within your risk tolerance and you're not in need of the funds, which if you're already making contributions, you've already factored that in, to continue to make those investments over time. That's how this all works to your advantage.
And I thought you made a great point before that, we want you to be retired for 25 to 30, maybe even 35 years. You could be retired, in theory, longer than you were working.
That's right.
No question. I guess the last thing would be is let's look at it doing a little cleanup.
Spring cleaning?
Because with many cases, folks may have credit card debt. They may have home equity loan debt. They may have student loan debt. Cleaning those up. If we can clean those up before you retire, what we're going to be doing is reducing your outflows, which makes your inflows more valuable and, more importantly, can reduce the amount of capital required to dedicate to that specific purpose, which gives you a little more liquidity, flexibility, and frankly, maybe what you're also doing is reducing the percentage that you're pulling. You're getting more into under the 4% number, more into the safety zone. And just sort of as a final comment on that, with our clients, we talk about 4%. We want them to go to 4%. They do. Sometimes they're higher, sometimes they're lower. But as they're stacking up the Benjamins, as I like to say, during the last 2 years, what's happened? We're not drawing it down. We're doing it specifically so we can continue their income flow that they've had, even when they've had a little bit of a pullback. That's important. Having that flexibility is important. And also what's important is, you want to come in for a coaching session, you know what to do. Just give us a call, 314-863-0008. Again, 314-863-0008. See you next week.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.